A bank is one of the only businesses on the planet that gets paid for holding your money, paid again for lending it out, and paid a third time when you spend it back. It is also the business that can vanish in 36 hours when a few people on Twitter decide to pull their deposits on the same morning. In March of 2023, Silicon Valley Bank, the 16th largest bank in America with over $200 billion in assets, was solvent on a Wednesday and gone by Friday afternoon. In that same year, JPMorgan Chase posted nearly $50 billion in net income, at the time the highest annual profit in the bank's history. Same industry, same 12 months, same set of rules. And yet the largest American bank trades on the public market at a multiple lower than the average software company, even though its profit margins look a lot more like a software company than a financial intermediary. By the end of this video, you'll know exactly how that's possible, how a bank actually makes money, why holding $200 billion in deposits still isn't enough to save you, and why banking isn't really the business most people think it is. The first thing you need to understand about this business is that the product itself is not what you think it is. When you deposit money in a bank, you're not parking it there. You're lending it to the bank at a rate so low it usually doesn't keep up with inflation. The bank then takes that money and lends it back out to home buyers, to credit card users, to corporations at a much higher rate. The bank's actual product is the gap. There is a specific name for this gap. It's called net interest margin. As of the fourth quarter of 2025, the industry-wide net interest margin for FDIC insured institutions in the United States hit 3.39%, the highest level since 2019. Community banks were running 3.77%, large banks closer to 3%. For context, that means for every $100 sitting in deposits, the bank is pulling somewhere between $3 and $4 a year out of the spread between what it pays you and what it charges someone else. Multiply that across trillions of dollars in deposits, and you start to see the shape of the business. Here's the part most people miss. A bank doesn't sell loans. A bank doesn't sell deposits. A bank sells a spread between two interest rates that you, the customer, are sitting on both sides of. You think you are a customer. You are actually both ends of the transaction when somebody sits down to value a bank. Not a hedge fund, not a private equity buyer, but an actual investor with the spreadsheet open. They are not looking at it the way they look at a normal business. They are looking at it as a leverage machine wrapped around a spread. The logic is straightforward. Let's say a bank has $10 billion in deposits. It is legally allowed to lend out nearly all of it. Once those loans get spent, the money lands in another bank. That bank lends it out. The cycle repeats. Economists call this the money multiplier. Bankers call it Tuesday. Step back for a second. A regular business needs to find $1, do something useful with it, and get more than $1 back. A bank needs to find $1, hold it, and rent it out at a different price than the one it pays to hold it. The dollar never has to leave. The dollar never has to do anything. The dollar just has to sit there long enough to be priced on both sides. Banking is the only major industry where the inventory pays you to keep it. But the spread is only half the story. The most interesting part of this business is everything that happens on top of the spread. Pay attention to this. When you swipe a credit card, your bank, the one that issued the card, collects an interchange fee. In 2024, Visa and MasterCard credit card swipe fees in the United States totaled approximately $111 billion. That number was just over $100 billion in 2023. It was $25 billion in 2009. Swipe fees have more than quadrupled in 15 years, and the largest piece flows directly to the card-issuing banks. When you overdraft your account, your bank collects an overdraft fee. Even after years of regulatory pressure and consumer pushback, JPMorgan Chase and Wells Fargo each collected over $1 billion in overdraft fees alone in 2024. The industry total at banks with more than $1 billion in assets came in around $6.1 billion. Add credit unions and smaller institutions, and the figure climbs to roughly $12 billion in a single year. The average overdraft fee at the largest banks, $34 to $35 per occurrence. When you have real money, somewhere past $1 million, the same bank quietly moves you into a different building. That building is called wealth management. Morgan Stanley's wealth management division alone pulled in $26.3 billion in net revenue in 2024, with a pre-tax margin in the high 20s. Total client assets at that single business unit, $6 trillion. So you have three layers stacked on top of each other. The spread layer, where deposits get rented out. The transaction layer, where every swipe and every overdraft pays the bank a toll. And the wealth layer, where the same bank charges you a percentage of your money to look at it. You walked in to deposit a paycheck. You walked out paying for 3 different products. You never noticed any of them. So at this point, you might be wondering, if banking is this favorable, why do banks ever fail? The answer is in the same mechanism that makes them profitable. A bank's deposits can be withdrawn at any moment. A bank's loans cannot be called back at any moment. That mismatch, short-duration money funding, long-duration assets, is called maturity transformation. It is the engine of the entire business. It is also the trapdoor underneath the entire business. In March of 2023, Silicon Valley Bank found out what that trapdoor feels like when it opens. SVB had been the favorite bank of the venture capital world. Between 2018 and 2021, its deposits ballooned from around $50 billion to nearly $190 billion. The bank took most of that money and parked it in long-dated U.S. Treasury and mortgage-backed securities, supposedly the safest assets in the world. Then the Federal Reserve raised rates at the fastest pace in 4 decades. The market value of those long-dated bonds collapsed. SVB was sitting on enormous unrealized losses on its securities portfolio. And here is the critical detail. 94% of its deposits were uninsured, meaning they sat above the FDIC's $250,000 coverage limit. When the news started spreading, those depositors didn't wait. On March 9, 2023, customers attempted to withdraw $42 billion in a single day. Withdrawal requests pending the next morning totaled $100 billion. The bank had over $200 billion in assets the week before. By the end of the week, it was in receivership. The cost to the Deposit Insurance Fund, roughly $16 billion. 2 months later, First Republic Bank, also with over $200 billion in assets, failed for nearly the same reason. Long-duration assets, short-duration deposits, a run that happened faster than the bank could sell its way out of. Here is the part most people never connect. Your checking account right now, the money you'll use to pay rent next week, is funding loans that won't be repaid for the next 30 years. SVB didn't fail because it did banking wrong. It failed because it did banking exactly right, and then the wrong depositors panicked at the wrong time. The only reason your bank still works is that you and a few million strangers have quietly agreed not to ask for your money back on the same day. The same year SVB collapsed, JPMorgan Chase reported a record annual profit. Not despite the banking crisis, partly because of it. JPMorgan bought First Republic's loan book at a discount and absorbed a wave of depositors fleeing smaller banks for institutions perceived as too big to fail. This is the part the textbooks don't quite explain. A banking crisis doesn't usually destroy the banking industry. It concentrates it. In 1984, the United States had 14,483 FDIC-insured commercial banks. By 2023, that number had fallen to 4,027, a decline of roughly 72% in 40 years. Most of those banks didn't collapse. They were absorbed, quietly, over decades. By the time the latest crisis arrived in 2023, only about 4,500 banks were left, and that number keeps shrinking. Between 2020 and 2025 alone, the total number of U.S. banks dropped another 13%, while the average asset size per surviving institution grew by a third to roughly $5.8 billion. Here is where the number gets stranger. Between 2002 and 2007, the United States chartered around 149 new banks per year. Between 2020 and 2025, that number dropped to about 8 per year. New banks have effectively stopped being created in the United States. Regulatory capital, technology infrastructure, compliance overhead, the barriers to starting a new bank have made it an unusually expensive thing to do, which means the industry is doing something unusual. It is becoming a closed system. The number of banks shrinks. The size of each survivor grows. The customer base stays exactly the same. The fees keep compounding. JPMorgan Chase, the largest of the survivors, generated roughly $177 billion in revenue in 2024 and pulled $58.5 billion of that down to net income, breaking the record it had set the year before. That is a net profit margin of about 34%. Return on tangible common equity, the metric bank investors actually watch, came in around 22% for the year. For comparison, Walmart runs at a net margin under 3%. Costco closer to 3%. Even Apple, the most profitable consumer business in modern history, comes in around 25% on net margin. A bank, dollar for dollar, generates margins closer to a software company than a traditional financial intermediary. And as the number of banks falls, your options fall with them. Fewer institutions means fewer places to walk to when you don't like the terms. The system has been built around the assumption that you won't walk. Your direct deposit goes to the same account it went to last year, and so do your auto pays. The cost of leaving your bank has been engineered upward for 40 years, while the cost of running the bank you would leave for has been engineered downward to almost nothing for the people who already own it. Time to pull it all together. A small community bank with $2 billion in assets, the kind of bank most Americans actually use, typically pulls down somewhere between $20 and $40 million in net income in a normal year. The bank's owners may have started it 20 or 30 years ago with a few million in capital, and the math has been unusually favorable to them ever since. A regional bank with $100 billion in assets, roughly the size SVB was before things went wrong, can clear $2 billion in annual profit in a normal year, 5 times the return of a comparable industrial business of the same revenue size. A megabank, a JPMorgan, a Bank of America, a Wells Fargo, can clear tens of billions in net income in a single year while paying out tens of billions more in dividends and buybacks on top of that. JPMorgan's 2024 return on tangible common equity of 22% means that for every dollar of working capital its shareholders left in the business returned 22 cents in 12 months. There is almost no other industry at that scale that produces those numbers consistently. And despite all this, the largest American banks trade on the public market at lower multiples than the average mid-tier software company. Investors apparently still think banking is boring. Boring is exactly the brand the survivors want. So here is the picture, finally assembled. A bank gets paid for holding your money. It gets paid for lending your money. It gets paid every time you swipe. It gets paid when you overdraft. It gets paid when you build wealth. It gets paid when you move that wealth somewhere else. The product is not the loan. The product is not the account. The product is your continued participation in a system that prices both ends of you against each other, year after year, decade after decade, until the day you forget there was ever another option. A bank is one of the only businesses on earth that gets paid coming in, going out, and standing still. The trapdoor is real. Just make sure you're standing on the other side of it. Thank you for watching.